Stop. Don't scroll past this number. This week, someone sent me a dataset and said, look at this. Over the past 12 months, silver mining stocks are up 126%, gold mining stocks up 99%, silver up 108%, gold up 49%, the S&P 500 up 14%, bonds barely moved 1%. And then there's one line you can't ignore. Bitcoin down 21%. Read that again. The asset that half the internet has called digital gold for the past 5 years, the one that was supposed to replace precious metals, is the only negative number on that entire list. Meanwhile, silver mining stocks didn't rise over a full cycle. They surged 126% in just 12 months. That's not noise. That's a signal. And that's the context we're standing in today. A context the market still hasn't fully priced in, because what's happening isn't just about performance, it's about structure. From the Treasury data released this week to insights from one of the most respected technical analysts in monetary metals, there's something here I can't ignore. I'm John Agg. This is Golden Exchange. And if you think those numbers are just history, you're about to realize they were only the beginning. Let's start with where we are right now. Today is the final trading day for the March silver contract on COMEX. And as the delivery window closes, every open position is left with only two choices: step away or take physical silver. Yesterday, 275 delivery notices were issued equal to 1.375 million ounces. But that's not the real signal. After those notices were sent, open interest increased by another 106 contracts, not closing out, not rolling forward, but opening new positions to take delivery of physical metal. That's not a signal about price. That's a signal about behavior. Someone is looking at the same data and they don't want paper. They want metal. Right now. Meanwhile, registered inventory on COMEX has dropped 13.2% in just 30 days, equivalent to 11.6 million ounces disappearing. Coverage ratio? 13.5%, below 15% is where stress begins to show. Paper leverage now sits at 7.4 to 1. And at the current rate of withdrawal, the system has roughly 131 days left. February alone, 25.18 million ounces were delivered, the highest in modern history. January, 33.45 million ounces left the vaults in just 7 days. This isn't volatility. This is pressure building. 26% of registered silver gone in just 1 week. And March is now following the same trajectory. Only 3 business days remain before April's first notice day. 1,830 contracts are still open, equivalent to 9.2 million ounces of potential physical demand. This is not an outlier month. This is the 6th consecutive month where delivery demand has exceeded historical norms with no sign of slowing. And while vaults are being drained, the outside world is telling the same story in a different language. This week, Bloomberg reported, Central Bank of the Republic of Turkey sold and swapped around 60 tons of gold, over $8 billion within just 2 weeks after the Iran conflict began. 6 tons in the week of March 13, 52.4 tons in the week of March 20. Some of it was sold. Most of it used as collateral to access liquidity. Understand what that means. A government is using gold, the final asset, to defend paper currency. And then there's an image. A small gold shop in Turkey. A man standing in front of the glass. 3 handwritten signs. The first line begins with Tilla, a vow that what he is about to say is absolute truth. When markets start making vows, that's when you should start listening. The second sign, 28 years as a jeweler, and for the first time, no gold. The third sign, written in large letters, if we had it, we would sell. That man didn't write a report. He didn't need charts. Just 3 pieces of paper, and in them more truth than 80% of financial analysis out there. Because when paper currency begins to lose value, or even just feels like it is, capital moves. First into physical gold. But when gold becomes scarce or trades at a $5,000 premium like in Istanbul, the flow doesn't stop. It shifts into silver. Not as a second choice, but as the market's balancing mechanism. Empty display cases in Turkey and drained vaults on COMEX. These are not 2 separate stories. They are one story, told from 2 ends of the same supply chain. And then there's a statement, one that sounds extreme until you place it in the right context. Michael Oliver, who entered the market in 1975 and correctly called the 1987 crash, recently said, "When everything transitions into a new reality, silver could reach $300 to $500. Pause there. $300 to $500. If you only look at the chart, that sounds irrational. But if you look at physical flows at behavior at scarcity, then maybe the most irrational assumption right now is that everything goes back to normal." This is the same man, Michael Oliver, who accurately called the correction from $121 in January and made it clear it wasn't the end, just a pullback within a bull market. He was right, and now he's saying $300 to $500. The first reaction? It sounds extreme. The second reaction, more important. What is the framework behind it? Because if that number comes from a consistent structure, then this is no longer a prediction, it's a consequence. The first pillar, a 50-year range breakout. For half a century, silver was locked between $5 and $50. 1980 cents quelled 4011 failed. But in 2025, silver broke above $50 and didn't come back. It ran to $121.67, a new nominal high. Historically, when a multi-decade range breaks, the expansion often equals the range itself. $5 to $50, a $45 range. Applied on a logarithmic scale from the breakout point, the projected target approaches $500. Not opinion. Measurement. The second pillar. The gold-silver ratio. 2024, 100:1. Spring 2025, 50:1. Now around 2% valuation relative to gold. Historically, 1980, 15:1. 2011, 33:1, 3.1. If this cycle only returns to the 2011 level and gold reaches $8,500, then 3.1% of $8,500 is $263. And that's the conservative case. So the question isn't, is $300 too high? It's, do you accept the premises or not? 6.5% of $8,500 is $552. The $300 to $500 range isn't random, it sits right between two historical extremes. The third pillar is simpler than you think. Eric Sproat takes the 1980 silver peak, 49 DAX, and adjusts it for M2 money supply growth. Over 4 decades, QE, deficits, stimulus, bailouts, the number of dollars in the system has expanded exponentially. So where does silver need to be today to match its 1980 purchasing power? The answer, hundreds of dollars. Not because of some exotic theory, just because there are more dollars. At $74, silver is still undervalued in monetary terms. It hasn't caught up. But the most important part isn't the number, it's the mechanism. A market suppressed for too long doesn't eliminate pressure, it accumulates it like a coiled spring. And when that pressure breaks, price doesn't return to fair value, it overshoots. Because the buyers who were denied at $20, $30, $40 are still waiting. Because short positions built on the assumption of a low-price regime are forced to cover at $80, $90, $100. Short covering price rises, margin calls more buying. A self-reinforcing loop. In the interview, they said, you could see $10, $20 in a single day. That's not hypothetical. January 2026, silver moved from $80 to 121 days. 41 seconds. 3 weeks. It already happened. And this may be just the preview. January may have been the first pressure release, not the only one. But I don't know that for certain. Even people like Michael Oliver can be wrong. The model can fail. History may not repeat. The Iran conflict could end. The Federal Reserve could surprise the market. China could reverse its silver export controls. And eligible silver could flood into the system, easing pressure immediately. All of that is possible. And yes, the short-term argument is valid. Oil rises, inflation rises, higher rates. Silver becomes less attractive. We've seen it. Price dropped from $93 to $74. But here's what the market is missing. That same conflict is accelerating the energy transition. The International Energy Agency confirms it. Countries are pivoting due to geopolitical security, and every solar panel requires silver. It can't be recycled back quickly. It doesn't return to the market for 25 to 30 years. Short-term negative, medium-term structural, and the physical data is clear. Vaults are still being drained. Delivery demand remains elevated, even as price dropped 42%. What does that tell you? Real buyers aren't waiting for price stability. And if you're stuck from the January highs, you're not alone. But this is exactly how precious metals bull markets test conviction. Look back at history and don't let corrections mislead you. From 1976 to 1980, gold rose nearly 8 times, but along the way were 20%, even 30% drawdowns that convinced people the cycle was over. 2001 to 2011, same pattern. So the drop in silver from $121 to $74, it sits well within the normal range of a bull market. The structure hasn't broken, it has only bent. 2 years ago, $29. 1 year ago, $28. October 2025, $52, the first break above a 50-year ceiling. January 2026, $121.67, a new all-time high. Today, $74, consolidating. Meanwhile, physical inventories continue to decline. Coverage ratio, 13.5%. The April delivery cycle is approaching. And Michael Oliver, who was right before, is now saying $300 to $500. This is not a year of good sentiment. This is a structure being built. I don't know where price goes. No one does. But the last 12 months of data say this clearly. Silver wins. The market is wrong. What do you see, opportunity or noise?